Okay, let's do FIFO now, first in, first out. And again, this is the way the company will assume their inventory flows. Now, what physically happens, we don't really care. So in other words, if you take the newer stuff out as a customer, you're not messing their inventory system up. So let's go through. We have, again, the same example as we did with the average cost. We had 13 units at 10 each, so our beginning inventory is 130. We now are buying 12 more at 11 each, so you're going to get inventory. The amount is $132. That's the 12 times the 11, and typically you buy it on account, accounts payable. Debit what you get, inventory, credit what you give, accounts payable. Now we're going to use first in, first out. It's September 25th, and we're selling 15 units at a price of $16 each. So the price they're going to charge their customer is 16, so their sales will be 240. And typically, again, it's on account, but that information is would be given to you. I'm telling you now that it was on account. Now we need to match the cost of the sales with those sales. In other words, we need to show that we have used inventory. And what we're doing is we're assuming we sold the first items, that's being the older. So look at these as shelves. We're going to clear this shelf first and then move on down to the more recently purchased items. So we're going to take all, we sold 15, so we have to take all 13 of these, and those are at $10. And we sold a total of 15, so we need to take 2 more from the $11 shelf, and that gives us a total credit to inventory of $152. So that's the using up of the asset is the expense, cost of goods sold. Now what's left? What's going to be in inventory? Well, these are all your goods available to sell. They can only be in one of two places. They either have gone out the door, sold as cost of goods sold, or they're still here in inventory. Well, what we have left are 10 units because we had 25 available, sold 15, so we have 10. But which 10 are they? Well, they're the newer items, because we sold the older items first. So 10 at 11 gives you 110. So this is all the goods available to sell minus what you sold equals your ending inventory. Now, companies at the end of an accounting period will actually have to go in and count their inventory and make sure that that 110 is actually the correct amount, but we'll talk about that later.